If you're thinking about becoming an accountant, or maybe you've just started your career in accounting, you probably question whether the profession is safe. Now, with all the change going on when it comes to AI and offshoring and private equity, no one can really blame you for thinking this. And I'd be lying if I said these thoughts hadn't crossed through my own mind. In this video, I'm just going to talk about the current state of the profession, what some of the threats and opportunities are at the moment, and really whether or not I think the profession is safe, and also what you can do about it to future-proof your career and stay relevant. If you're new to the channel, my name's Callum. I'm a chartered accountant here in the UK, and I make videos for new and aspiring accountants who want to level up their career and also future-proof their skills. So if that sounds of interest to you, be sure to subscribe, and let's dive right into the video. So is accountancy a dying profession? Well, a report by Wolters Kluwer, who are like a big software provider in the accountancy space, they did a bit of research on accountancy firms, and they surveyed 2,700 firms worldwide, finding that 83% of them had reported revenue growth in 2025, and profitability had improved for 79% of those firms. A bit more further research done by Xero in an industry report found that 77% of firms in the UK were optimistic about the future. So with all that said, it looks like the profession isn't really dying, but it's pretty clear that there is a lot of change going on currently. And that first major shift, I believe, is in artificial intelligence. Now, that Wolters Kluwer report found that global AI usage in accountancy firms had increased from 9% in 2024 all the way up to 41% in 2025. And that 35% of firms were already using AI daily, with 77% planning to increase their investment in AI over the next 3 years. So it's pretty obvious that accounting firm leaders are wanting to get a piece of the pie when it comes to artificial intelligence and really start using its ability to improve efficiency and profitability. Now, obviously, AI is in the early stages and it feels like new tools are popping up every single week. So it's quite hard to pinpoint exactly what this is going to look like in the years to come. But I can imagine that many of the routine tasks that accountants are used to doing, whether that's data entry or reconciliation or bookkeeping, are going to gradually become automated and free up a lot of time for new tasks to be taken on. I think the profession is going to move very much from a compliance backwards looking focus to become more advisory and future looking. And this is really going to shape the roles of the future. I think this is going to create a lot more opportunities for people to get into accounting, but it's also going to change the shape of how entry-level roles look in a lot of firms. So it's going to be interesting to see how this really develops. Now, while it's pretty clear that AI is going to replace a lot of the current tasks that might be done by juniors, I do think there's going to be a lot more opportunities that are going to come out of it, particularly when you look at the potential it has to free up time to focus more on the advisory and judgmental areas, which, to be honest, I think a lot of people would agree are the more interesting parts of the accounting role. So just like the internet replaced a lot of tasks back in the early 2000s, I think accounting is going to do the same thing in 2025 and beyond over the next 5 to 10 years. So if you are just starting your career in this space, it's obviously something that you can be concerned about, and I wouldn't blame you for that, but also realize that there's going to be a lot of opportunity that comes out of it, and it's a chance to really shape your career around the modern day technology. Next up, I want to talk about M&A and private equity. The same Wolters Kluwer report found that 26% of firms had reported a merger in the past 3 years, along with 32% receiving private equity investment. Now, it's pretty obvious that with this private equity money and the consolidation that's going on, that a lot more capital is going to be piled into some of these firms, which can be used to improve the infrastructure, create new service lines and new opportunities, and to invest in technology to make the role more interesting and free up a lot of people's time to focus on more of the value-added tasks, which I think is really what PE is going to aim to do, because ultimately they want to make a profit from their investment at the end of the day. So these cost-cutting measures and investments in efficiency are going to allow them to do that. This consolidation is also allowing for smaller firms to be brought into these larger networks, which is going to reduce the risk of small firm instability, as they say, as these merged firms can spread the risk across multiple different service lines and also have the capital to withstand some of the downfalls that can occur. But with this private equity money comes a high pressure on performance with possibly greater tracking of billable hours and utilization, which can really translate into more demanding environments. So just because PE money might make a firm more safe, it doesn't necessarily mean it'll make it easier. This consolidation could also reduce the number of small firms, as I touched on, which could reduce the entry-level roles open if there are less of these firms, or at least change the culture and dynamics of the roles. So whilst there are plenty of positives, there's also some negatives that may come out of this, and it's important to sort of keep an open mind to it all. But ultimately, it shows that this investment in accountancy firms are clearly anticipated, so there could be an element of safety behind that because this PE money wouldn't pile into these firms if there wasn't a future in them. So I guess you can take some comfort from that fact when it comes to pursuing your career in accountancy. My third point is about offshoring. Now, if you're not familiar with offshoring, it's effectively where firms are outsourcing a lot of their work to overseas businesses, whether that's third-party subcontractors or part of the same company in different countries, to basically cut their costs on offering the work to make more profit. Because it can be a lot cheaper to outsource it to a different country than to do the work in that domestic country. Now, research from the ICAW last year found that 49% of firms had offshored parts of their audit surface, and that same research found that the number of billable hours charged by those firms had increased 86% over the past 3 years, with a further 71% increase expected within the next 3 years. So it's pretty clear that offshoring is becoming a large part of a lot of firms' strategy. Now, offshoring obviously allows firms to outsource a lot of their recurring tasks and possibly the tasks that are a lot cheaper to service offshore rather than do in-house. This is largely around data entry, reconciliation, bookkeeping, payroll, that kind of stuff. So it could open up more opportunities for staff in the local countries to do more value-added or advisory work. Now, the routine, lower judgment tasks are obviously more prone to being offshored, which for new accountants is what a large part of their role probably is at the moment. So saying this, it could reduce the number of entry-level opportunities available. And it may also lead to skill gaps for people that have spent a large part of their career on this compliance-led work, who don't have the exposure to advisory. So you could argue that your career could be less safe if you haven't had that advisory experience. But equally, it does provide an opportunity to upskill and really focus on the value-added advisory tasks if you can. Offshoring could also lead to downward pressure on pay and progression, as those onshore teams may need to justify their value differently, particularly if the offshore service providers can start offering this more judgmental value-added work. There's definitely a lot of factors at play here, and it's one to pay attention to in the coming years. So with all that said, is the profession really safe? Well, in my opinion, yes, it is, but only to those willing to adapt. It's pretty clear that accountants are going to need to focus more on the advisory value-added work as opposed to the compliance backwards-looking stuff. So what are some of the things that new and aspiring accountants can do to really solidify themselves? Well, I think firstly, it's about mastering the fundamentals. Obviously getting your exams done and getting technically competent, but also really establishing yourself in a certain niche, whether that's audit, tax, accounts, ESG. There's so many different avenues you can go down, and really specializing in one can make you stand out and really help future-proof your career. I'd also focus on building the tech and digital skills, whether that's with Excel and learning all the formulas, or just taking the time to look into different tools on offer and how to use AI in your day job. And finally, I'd really cultivate a business partner mindset, thinking beyond the numbers and really diving into the value you can actually give past just being a number cruncher, particularly for non-finance stakeholders who perhaps haven't had that finance and accounting training that you've had. Being able to simplify this complex topics and put it into a way that's easily understandable is a skill of itself, and one that I can really see employers looking for in the years to come. So I hope you found this video insightful. Feel free to subscribe if you want to follow along on the journey and receive more insights into the accounting profession. And I look forward to seeing you in the next video.